Hi folks, and welcome back to Meaningful Money. Here I am on top of the world. This is Eskel's Cliff. There's about a 500-foot drop there and about a 500-foot drop there. All you can see behind me is the sea, I imagine, and I'm not moving to show you any more of it. Some people up behind the camera at a house up there wondering what the hell I'm doing. Just wanted to summarize retirement options, particularly how you get your income out of your pension pot. We've looked at them all in detail. Specifically, I'm talking about annuities, drawdown, and then phased retirement. Last time we looked at alternatively secure pension, ASP, which is sort of post-age 75, 77. So I'm not going to include that in today. This is sort of if you're 55, 60, 65, what your options are. Just summarizing them. Let's look at annuities first. We looked at those in episodes 53, 54, and 55. An annuity is where you hand over your money once and for all, your pension fund, to get an income for life. This is the way that it always used to be done. But remember, there's pros and cons with those. When we're thinking about the pros, one of the benefits, the key benefits really, is a guaranteed retirement income. Once you've handed your money over, the quid pro quo for that is that the insurance company you give your pension fund to give you a retirement income, a guaranteed income for the rest of your life. Another one of the pros, the good reasons for doing that, is that there are options you can choose. So you can choose whether your income stays level or goes up. You can choose whether you provide an income for your spouse and how much if you die first. So those options are useful. But the downside is that once you've done it, an annuity is a one-off, irreversible transaction. You can't undo it. You can't change it if your circumstances change, which is a big reason why you might not want to do an annuity. And if you're making that decision at age 55 or 60, then chances are you've got 30 years worth of life left to live, and a lot can change in that time. So annuities are great if you have no desire for any kind of investment risk going forward. If you want to know exactly what's coming in income every month, then annuity is almost certainly the way to go. Remember though, the last sort of con, if you like, reason why annuities might not be such a good idea is the ultimate risk of all, and that's mortality risk. You've no idea how long you're going to live. So if you're happy taking that risk that you might die soon after buying your annuity, then go for it. But ask your advisor about any sort of capital protection on the annuity or any kind of life assurance bit attached to it. Remember that we talked also briefly on episode 55, I think, about alternative annuities. So fixed term annuities, which go to, say, age 75, and then give you a bit of fund left at the end. There, can be a good idea to get around the fact that your circumstances might change after you've chosen your annuity. So that's annuities. The alternative, the main alternative, is drawdown or unsecured pension. Now the pros here, remember, is that the income is flexible. You get a minimum level of income and a maximum level of income, and you can choose your income level that you actually want between those two, maximum and minimum. And you can change it year on year, which makes it useful for planning. So we do that quite a lot with our clients. We'll look at what they need this coming year. Are there any other sources of income coming in? While we're watching their tax situation, we can use their drawdown plan to increase or decrease their income at will. Very useful tool. And obviously, while the fund remains invested, a good side is that the fund can grow. On the downside of drawdown, though, is that the fund can go down because it remains invested. So there's investment risk to take into account as well. There's the cost of drawdown. Because you remain invested and because there's more administration to do, there are explicit costs, which there aren't under annuities. And so those need to be taken into account. And generally speaking, you need a decent-sized fund to go into drawdown to make those costs worth it. And the big one, remember the technical term, mortality drag. We dealt with that in episode 57, which was the drawdown one. Mortality drag is, do you remember under annuity you get cross-subsidized? So those that live for a long time are subsidized by those that die very soon after buying their annuity. And that is all sort of put into the mix, and you benefit from that if you buy an annuity. But if you go into drawdown and you defer buying an annuity as a result, then you don't benefit from that. And that simply means that your drawdown plan needs to work that little bit harder to offset the loss of that benefit. And that's called mortality drag. So these are downsides of drawdown. But generally, they're a great idea if you're happy to take investment risk and if you're happy to incur the costs. then finally, episode 58, I believe, we talked about phased retirement, which is a way of sort of moving gradually into drawdown. Benefits of doing that, remember, are that there's good death benefits before you move your money post-retirement. There's much better death benefits pre-retirement because the money is effectively in trust and therefore free of inheritance tax and not part of your estate. Another good reason for doing phased retirement, if you don't need your tax-free cash lump sum, which you can get when you take your benefits, if you don't need that, maybe you've got plenty of money in the bank already, well, you can use that to make your income, at least in the early years, very tax efficient. The cons, though, are the same as drawdown, really. Cost, investment risk, mortality drag. So these are the main ways you take your money out of your pension. It's good to be taking money out and hope if you're doing that, then you're spending it, living the life you want to live. But there's costs and considerations for all of them. So it's fair to say that taking your income out of your pension is a big decision, not one to be taken lightly. And therefore, as ever, I'm going to suggest you get very good, independent financial planning advice from a fee-based financial planner to help you do that. That way, you know there's no vested interest and they're not trying to sell you something which suits them more than it does you. So it's a big decision, take it very seriously and get help with it. But hopefully this last few videos has been helpful in explaining the mechanics of how it all works and the pros and cons here now. So we've pretty much done pensions. We've done accumulation, saving money into pensions. We've done decumulation, getting your income out of your pension. So where are we going now? Well, we're going to talk about taxes. Yeah, deep joy. But Ben Franklin said, the President of the United States, said there's nothing more certain in life than death or taxes, or something like that. I've got the proper quote written down somewhere. Perhaps I'll get it right for next time. So taxation is really important. Particularly, it's a big consideration when you're thinking about financial planning. So we'll move on to taxes next time with a bit of an introduction. Thank you very much for watching, and from my precarious position on Eskells Cliff, high above Sennan Cove and Gwenver Beach, thanks for watching and see you next time.